Hi, this is Group 9. We're doing the VNU LBO transaction today. I'm Tim Davis.
I'm Aaron Kahn.
Paul McDougall.
And Gunnar Thorderson.
So to start off, we're going to be looking at VNU. VNU was founded in the Netherlands and is a global publishing and media company. VNU is active in more than 100 countries and employs nearly 41,000 people. Their total revenues in 2005 were 3.5 billion, and they're listed on the Euronet Amsterdam Stock Exchange. So in November 2005, the shareholders forced NVU back out of a merger with IMS Health. In December 2005, they finally received acquisition offers. The next month, VNU announces they have received a proposal from Valcon Consortium of private equity firms. In February 2006, they are still continuing to talk with the private equity firms. And then finally in March, VNU decides that accepting the offer was in the best interest of their stockholders. A few years later, after renaming themselves the Nielsen Company, they issue an IPO.
So on March 7, 2006, the supervisory board of VNU met after carefully considering three options that the firm could take. The first option was that the firm would continue to stand alone in their operations. The second was that they'd break up the company somehow. And the third was that they'd take the LBO offer. On that date, they decided that in the best interest of their shareholders, that they would take the LBO offer. Now let's dig in deep and figure out exactly what the main reasons and motivations behind taking the offer was and what the main concerns were for standing alone or breaking up the company. Now first with standing alone. Over the past 6 months from the time of the offer, VNU had worked on a standalone operating plan called Project Forward, where they really were focusing on bringing costs down and innovating their operations. Now, there were three main issues with this. First was execution risk. They didn't even know if they could pull it off. They didn't know if they could lower costs as much as they could because they were facing major price compression in the industry. The other main thing was the valuation offer. It was a really good offer, and they knew moving forward with standing alone that the likelihood that they'd meet a similar valuation by standing alone would be very tough. Now, with breaking up the company, there were even more issues involved. The first one was uncertain completion. Now, breaking up the company was going to be a huge ordeal. They were going to face tax issues. They faced many tax advantages from being a Dutch company, and spinning off certain US companies seemed like a major headache and ordeal. Also, there was a timeliness factor that came into as well. But the main issue we want to highlight here is the economies of scale issue. Now, in this industry, it was vitally important that they have as much market share as possible so that they can keep their costs low because they have a bigger operation. And so by spinning off their good companies or even their bad companies, they'd be losing a lot of that economies of scale factor. So that leaves us with the LBO. And what were the main issues that really motivated them to take the LBO? Well, they wanted to be able to get into new markets. They wanted to be able to innovate into new technologies, and they saw that the new owners that were coming with the LBO brought a lot of that to the table. And so that's why they were really motivated from that. They also fundamentally wanted to have private ownership. They wanted to have the freedom so they were escaping that the pressures of being a public company.
Now, the LBO participants of this deal, we had the Valcon acquisition team. This consortium consisted of the private equity investors of Alp Invest Partners, the Blackstone Group, the Carlyle Group, Hellman and Friedman, Kohlberg Kravis, Roberts and Company, and Thomas H. Lee Partners. In addition, there's the financial advisors and the investment banks that were associated with the deal. We had Citigroup, Deutsche Bank, JP Morgan Chase, ABN AMRO Bank, and ING. VNU also had financial advisors, in addition with Credit Suisse, Evercore Partners, and NM Rothschild & Sons.
After the initial offering by the LBO group, there was initial pushback by the shareholders. The interesting thing about this LBO is that the battle was watched very closely because it was one of the first times a big private equity buyout was agreed on friendly terms, but then fought back by the shareholders. Two prominent shareholders that voiced their opinions was Knight Vinck, a fund manager known for activist corporate governance, and Fidelity International, both of whom pushed back on the IMS Health LBO in the past.
Now let's take a look at how this deal was structured. We had an offering price of 28.75 euros per common share with 255 million outstanding shares, which equaled 7.6 billion euros. This included a multiple of 13.4 times the 2005 EBITDA, which compared to an average of 8.5 times the multiples in 2005. There's also a 3% premium over the closing price on July 8, 2005, which was roughly 23.37 euros. And this occurred after the planned merger with IMS Health fell through. Now, the value of the offer for the 7% preferred shares is approximately 2 million euros. And this value of the transaction equals 8.6 billion euros or 10.3 billion US dollars, including net indebtedness. And VNU also declared that they won't pay dividends on its common shares.
Moving on to the size and composition of financing, one of the highest leveraged media LBOs at the time of the transaction. The LBO transaction of 7.6 billion euros consisted of both debt and equity. 3 billion euros, representing 40% equity, was provided by the 6 private equity firms in the Valcon acquisition consortium. 4.6 billion euros, representing 60% of the debt for the transaction, was provided by the banking consortium.
So now let's dig a little bit deeper into the debt structure, the composition of the actual financing. So Valcon first entered into a $6.16 billion bridge loan to commence the cash tender offer to buy the outstanding 7.6% notes that were due. Now, this included a consent payment of $40 for each $1,000 that was in the principal amounts for those notes that was tendered, and it had to be done by the established consent date. But the bridge loan later was replaced by permanent financing for approximately $11.4 billion. Now, this consisted of 2 different types of debt instruments. The first is senior secured credit facilities. The first type was a 7-year, $4.2 billion and a 600 million euro senior secured term loan securities. The second was a 6-year, $688 million senior secured revolver that the company could pull from whenever they needed. Now, the second is debt securities. They had a couple types. They had a $650 million 10% loan, and then they had a 150 million euro 9% senior note. Those were due in 2014. They had a $1 billion, roughly 12.5% senior subordinated discount note. That was going to be due in 2016, and a 343 million euro 11.1% senior discount notes due in 2016.
Let's take a look at a few of the leverage ratios. When we take a look at when the deal started in 2006, their ratio was somewhere around that 9 to 10 range, which compared in Europe at the time of average deals at 5.2, so significantly higher. But as time went on through the years, up and leading to the IPO, which occurred in 2011, that leverage ratio took a significant decrease, obviously down to around 4.48 in 2011. Now let's take a look at the regulatory issues. We actually did not find any significant issues associated with this deal, but it's interesting that the wave of large leveraged buyouts in Europe seem to be putting strains on credit markets and causing concerns that participants may be planting seeds of their own downfall. Paul Waters of the S&P Leveraged Finance team in London, he stated that as deals get larger, sponsors are committing less of their own capital. And they've also picked up the recent trend in the US of taking out dividends through recapitalization. The counter argument is that buyout shops can push the limits in Europe because governments are more inclined than the US to step in to protect banks and jobs to limit the risk. And he says there's no tradition of blowing companies up when things go wrong. But the bigger picture here, it's interesting to note that within a few years, we went through and experienced the European debt crisis.
After the LBO in 2006, VNU has emerged much ahead of where they were. In 2011, VNU, having now named themselves the Nielsen Holding Group, initiated an IPO. The original offer was around 21% of the company for $25 a share. The offer they ended up taking was 82.1 million shares sold at $23 a share, raising $2.1 billion in capital. Since the IPO, they have maintained a share price higher than that $25 price point they originally were after, reaching a high of around $56 per share in 2016. It is estimated that the private equity firms that were involved in the LBO have a healthy return of 9.5% since the LBO.